Alright, so I wasn't planning on doing a market outlook video today, considering it's a holiday, and typically this Friday after Thanksgiving is a very light traded session and not a whole lot of movement, but not so much the case today. So I'm going to break down what happened from a technical. We all know what happened from a news perspective, but we're going to break down what happened from a technical perspective, and what does that mean? Like, did we get some breakdowns here, or is it still within the context? Is this drop still within a context of a previous rally? So we're going to break all that down. We're also going to talk about what were the biggest movers from an asset class standpoint. What's that telling us? Is this really risk off and risk? What had the biggest risk off moves, and what didn't participate in the risk off, and what does that tell us? So I'm going to break that down. We're going to take a look at our trade idea of the day and look for an opportunity that we might take advantage of this pullback for a bounce. We'll look at an example as to what that will look like and how. And we also have our Black Friday, as everything is Black Friday, right? Black Friday sale. So we have our Black Friday sale here at marketscholars.com. So let's go ahead and get started. Today is Friday, November the 26th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. So really quickly, before we look at the charts, again, we just want to remind you that we do have our premium plan for 20% off today using this coupon code. We've been very, very pleased with the response. We have had a couple of questions, so I just want to make this clear. To be able to use this coupon code, you have to log in here, or either log in if you already have even a free account with us, or if you are a previous subscriber and you're looking to renew, you can come over here. Just make sure you type in the coupon code as it's listed there. Black Friday, all one word. B and the F are capitalized. And like I said, you can pay directly right now with your card, or you can use PayPal. PayPal does have the option of paying over 6 months, same as cash, or no interest. You have to do that through PayPal separately. So this is the instructions on how to do that. Then once you have done that, then come down, again, fill out the coupon code, make sure you're using your PayPal account, and then hit that subscribe and click that box right there. Sometimes that might be the hang up. Click that box right there. I've read and agreed to the terms of service. Then you can hit subscribe for premium access. All right, well, let's go ahead and take a look at the S&P 500 with the market forecast indicator. And you can see the bloodbath today, but it's only one day and it's very news driven. It was a very light market, so take it for what it's worth. In fact, you can see the near term line, the momentum line didn't even finish below the 5th percentile. The near term line didn't even finish in the lower reversal zone. So that kind of puts in some perspective, like how really bearish this was from a technical perspective. The intermediate line still above 80. Market sentiment line still rising. So in fact, you could technically still call this a bullish intermediate confirmation signal, an oversold momentum line that wasn't too extreme, right? It stayed above the 5th percentile, and a strong bullish posture. It's still, the intermediate line still above the 80th percentile. So that's a bullish signal, especially when you consider the near-term line also being in bearish territory, but not oversold. That sets you up for a bounce coming Monday, right? If we were expecting a bounce on Monday, as it was across multiple other indicators, like we talked about in the last market outlook on Wednesday, then now you'd even more expect a bounce on Monday. The question will be how big of a bounce, right? Because you have to get back above that 23% line. Dropping below the 23% line is, a signal of an intermediate decline on this particular chart. However, we only less than 0.75% below the 30-day moving average, so it's not even that big of a decline. Remember, you have to get about 2.5% below here to really be on intermediate decline mode. So, it's not light pink shading yellow line because we're not below 50 on the green line here down here, but it's practically is, right? We've seen other instances here where you did get just the green line and the dip, and you bounce right off of that, and so we very much similar type pattern here. You can see on the S&P. If you look at the Dow Jones Industrial Average, you notice we are more than 2.5% below. In fact, we're in the 10th percentile of the 1-year chart. So we are more below the 30-day moving average. We were already light pink shading the yellow line as it was. Remember, the Dow's been a little bit more bearish than the S&P has been. We've got a red line now, and we are close to, we do have light pink shading. We are close to dark pink shading. But you also notice, too, that we stopped at the 62% retracement level, which is support, right? That's a technical support, and you can also see too that we're not too extreme on the momentum level, or on the short-term sentiment. Take a look at the NASDAQ 100. Again, we did drop below the 23% retracement. We had been holding that. We are now below that. We are still, above the moving average. Again, intermediate confirmation signal, kind of. I mean, we are at the 79.8 on the intermediate line, and the momentum line it's just a smidgen below 5. So technically, it's not, but in reality, that's pretty much an intermediate confirmation signal too, with the momentum line there, and we're actually still above the moving average. And then finally, your Russell 2000 on the market forecast. We are now below 40, just barely, or not actually, just a little bit above 40, but almost below 40. And we do have dark pink shading in the red line because we are below 50 on here. We didn't finish at the low. We held the 78% retracement level. So when you rally like this, or whenever you have a trending move, up or down, in this case up, and then you're trying to measure retracement of that trending move, the retracement starts when you break the 23% line and you have some support at these areas. The retracement ends when you get back above the 23% line and continue the bullish run, or it ends when you break the 78% retracement level and it reverses that run. At the lows of the day, we were below the 78% retracement level, and that was pretty bearish. But we came off of those lows and pretty much held that level for a support, which means that we are not now trending to the downside, that we are actually still in retracement mode, and that can act as a layer of support as well. And again, you can see short-term sentiment's not that bearish. We are 4% below the moving average, so we are in intermediate decline, however long that lasts, right? But we are in intermediate decline. Intermediate line has dropped below its market sentiment line. If you take a look at how the weekly candle ended up looking for the S&P, we barely have a negative differential down here, which means we have a red candle up here, which means the close is lower than the open. We do have a falling PPO, just barely turned down this week, but we don't have a red arrow yet. So that's the three things you need for this chart to tell you you're in intermediate decline. Obviously, you do have that with the Russell 2000. Red arrow, pretty significantly bearish candle, very negative differential here, and then your PPO is falling. Your Dow Jones Industrial Average also has the three things: the red arrow, the negative differential, and the falling PPO. But of course your S&P with that neutral candle, and then your NASDAQ also with a relatively neutral candle. The neutral candle means a small body and a upper and a lower shadow. So you don't get lower shadows when you're bullish, and you tend to close above the highs, and you start to get less bullish when you don't close above those highs, and then of course when you get an upper and a lower shadow. So you do have a convergence on the differential as it's falling, and you are got a small decline on the PPO, but again, no red arrow. So if you look at the three green arrow chart here, you can see we got three red arrows, which, again, one day of light pink shading typically can lead immediately to a bounce. So take that for what it's worth. We don't even have that on the Qs. We only have two red arrows. Now, again, on the Dow and the Russell, we've talked about that it should only take 1 or 2 days of light pink shading. Or pink shading to avoid an intermediate decline. That's not the case for these. I mean, we've had now 4 out of 5 on the Dow. We've had 4 in a row on the Russell, and they're so far below the moving averages, they're not going to turn green anytime soon unless we really fill in those gaps from today immediately. So they're in intermediate decline according to now multiple charts, including this one. And the S&P and the NASDAQ should bounce again Monday, and if not, then there's a good chance that we can get some divergence going there, and that's what we talk about here with this chart, with the S&P in divergence mode. The MACD is below its moving average and dropping, but again, just 1 day below the 17-day moving average. So we'll see if we finish below the 17 and more than 1.5 times the average volume on a half day of trading. That's a pretty significant, not extreme on an absolute basis, but when you consider it's only a half a day, then it's pretty extreme volume. There's your Russell 2000, and this is a pretty significant break. Now, so again, also half day trading with a lot of volume, your stochastics, both the actual stochastics and the moving average, are below in bearish territory. Your MACD is diverging to the downside now, well below the 17-day for multiple days, below the 200-day, the 8 and the 17-day crossing the 30. But we held the point of control, so we're still above the point of control in the 1-year chart. We could have been worse if we finished at the lows for multiple reasons, but we didn't. So, relatively good sign for small cap stocks. The Dow Jones, same thing. We finished above the point of control just barely. And we are below the 50-day moving average. We are diverging to the downside on the MACD, so we are in bearish divergence mode now, but your stochastics is bearish. Obviously, when you look at the RSI and the CCI, we are in bearish territory for SPX. We're not below 40 on the RSI, but we did drop below -200 on the CCI. We're well bearish territory on the Russell and on the Dow Jones Industrial Average. So bearish territory there on both those indicators. And of course your NASDAQ 100, not so bullish. In fact, neither one of them are in bullish territory. So, your NASDAQ, as we've been talking about, the Russell's got this very poor margin of safety. The NASDAQ's got a much better margin of safety. We've been talking about that for a long time. Even with the breakout now, which is now a fake out on the Russell 2000, breaking out of that sideways trend, thinking that, here we go. And now it's, definitely a fake out here, which, remember, is more bearish than just resistance holding, because it sucks in a lot of capital, a lot of longs, new longs on the breakout. And then now they're at more significant losses than anybody is, because they got in at the weakest time. So let's take a look at the directional movement index for the S&P 500. We were bullish. We're not bullish anymore. So we're obviously back, well above 20 on the negative, and now below 25. So it's not a bearish breakout pattern yet, but definitely not bullish anymore according to that indicator. You can also see too, your Qs still is bullish. So again, better margin of safety. Remember, the Qs kind of are a safe haven trade, have been for some time. Big breakout pattern on the Russell. So well below 20 on the positive, well above 30 on the negative. Big breakout pattern there, and a big breakout pattern on your diamonds. Well above 35, easily below 20. So big breakouts on your directional movement. Your diamonds, your ADX is below 20. Your IWM is also below 20. So they're in, they can trend for a while. This could trend for a while to the downside according to that indicator. Let's look at the Ichimoku trend cloud. Just a day below blue. So again, we bounce up on Monday. You notice we're still very strong trend on the SPY and on the Qs, right? So very strong. In fact, the Qs stayed above the blue line. So very good, much better margin of safety on those areas. Not the case for IWM, right? Now we are at the cloud, and we held the cloud on an intraday low and on the closing low. We are done with the bullish trend. As you can see, the red line is crossed below the price here, right there, and we have was now a weak bearish trend, so below -1, above 50. 2 and 65 are your next layers to solidify an intermediate bearish trend, and you're not quite there on the Dow, right? So breaking the cloud, the red line breaking below the price, which it has, getting it to at least -2 and 65 would solidify more of an intermediate trend. As of right now, it's a good breakout pattern, but it might be too extreme in a single day that it might be really easy to bounce off of. Here's your Bollinger Bands, and of course, here let me show you the TTM squeeze here. So we are inside the channels. The bands are breaking out, or excuse me, the bands are breaking back in. The Keltner channels are breaking out of the Bollinger Bands. You can see for the Q, so that's what gives you your red dot here when your Keltner channels are back outside of the bands. Not that it's the reverse for IWM. So IWM, big breakout to the downside below the lower band, just barely closing below. It was a lot more below, but also below the lower Keltner channel. So again, if we can get back above that Keltner channel, great. If not, those bands are going to widen out, And when you trade both between the band and the Keltner channel, that's when you're trending. So very important to watch on Monday. Obviously, well below the Bollinger Band and the Keltner channel there as well for the diamonds. The bandwidth is low and starting to rise. IWM, the bandwidth is already pretty high, was falling actually, and then turned back up. So very interesting. Like we got this breakout pattern, really extreme with today's volume and trading range, breakout pattern there. Now the question is whether it will actually hold. And so when you look at like IWM here, and where we close at 220, like there's the gap, right? And if you think, okay, is this a runaway gap, right? Which is a significant gap to the downside. So we gapped more than 2 standard deviations to the downside. We finished, remember, we don't get intermediate declines without a 2% drop. We actually did finish with a 2% drop on SPY. So and you can see, I mentioned to you before that when you get this big gap, that's when both lines rise higher. So when you have this opportunity for both, you can see both lines are rising higher here. That is a sign of the beginnings of an intermediate decline. That's the kind of move that signals the beginning of one. Small cap stocks were down 3% with a large gap to the downside. Your Qs, not quite, right? So almost below 2% and just barely more than a 1 standard deviation drop. So again, you see where the safety is right now. It's in these small, large cap areas. But you also see too on the intraday chart. Go back to this intraday chart here. That's a pretty size. I mean, we are in the lower half, well below the lower the point of control. Small cap stocks, big. I mean, this is a big Arun break. I mean, there's your big break. That's a bearish signal on the Arun indicator when you break up about to 100 and you close right at 100. So that's a bearish signal. Not quite on the SPY yet, and definitely not there on the Qs, but on the diamonds and on the Russell, a very bearish Arun crossover. So will this breakout, will this gap hold? That's the question mark, right? Whoops, I keep doing the wrong chart there. The intraday chart is what I want. So will this gap hold? That's the question. You can see we close at 221 here, down towards the low. Obviously a lower high and a lower low, closing below yesterday's low, or Wednesday's low, closing well below last week's low. So needless to say, it's a bearish close, lower high, lower low, closing below yesterday's low, closing below last week's low. A bearish Arun cross there, as I mentioned previously. SPY, lower high, lower low, closing at the low point. Closing off of the lows of the day, so at 458.97, so kind of in this area. So we were off of the lows for the day, but in the lower half of the chart and well below last week's low, well below the weeks before's low. So relatively bearish from that perspective. Q, not so much, right? Just barely. In fact, 391.20, yeah, we were just barely below last week's low point. And for that matter, barely below Wednesday's low point. So again, you can see where people flock to safety in times of volatility. They're still maintaining their positions in these large cap tech names. Maybe not the Cathie Wood ARK tech names, but definitely the large cap tech names. They're not up. They were down 2%, but you can see how the technical damage doesn't look nearly as bad on the Nasdaq. We did hold that week's low point. Not nearly as bad on a technical basis than what we're seeing the damage on like industrials and the small cap sector, which is more correlated right now with the risk trade than the Nasdaq 100 is. Here is your break on the VIX. We did get up above 100%. We closed below 100% because the VIX 3M jumped up quite a bit here, so up to 29. So big jump on the VIX 3M. You can see the VIX was up 54%, but the VIX 3M jumped up 33%. So the VIX 3M made a nice good run higher, and that brought when we were above 100% back down. So, but we did clearly go through 90-95%. They will now act as a support on any kind of declines in volatility, any intraday declines. So just kind of keep those picture. I mean, remember, we don't get intermediate declines typically. Now we did here. This last intermediate decline, we didn't get above 100%. So, and we still technically aren't above. We're not closing above 100%. So you don't typically get intermediate declines without it. And I know, there's your exception over here. There's the anomaly. But you typically get above 100. In fact, you typically get up to 105% when you're on intermediate declines. So again, a Monday morning, if we continue this up to 105%, then we know, okay, this is it, and you probably have some unseasonally bearish Q4 moves. Otherwise, if we fall back down to 90, especially if we get back into this neutral zone, one day crazy sell-off, nothing more than that. I mean, as you saw, the volume and the volatility were extremely high. The 112 million on the half day of trading, mind you, and then again the close at 469.44. The high was at 463.90. So the high 43.60.90. So you're looking at about half a point. We get 464.5. So about 5.5 points. Add that on. So you're looking at about 11.5, 11 2/3 versus 3. So huge range compared to the average. Huge, well off the charts, right? And then the volume 112 million it's way up here, pretty much off the charts. Again, for only a half a day of trading, relatively had a little bit more than half. Those are huge extreme numbers that typically, it's that kind of sets the low point, right? Those kind of extremes typically set the low point. So I would expect Monday that when regular volume comes in, or a full day's worth of trading, and people are back from vacations, and news of this variant settles down a little bit, I would fully expect that we'll bounce off of that. But obviously the technical patterns are there for a continued intermediate decline. That if it shifts into the Qs, then okay, now we are in full-on broad levels. But as of right now, it seems to be very targeted to the reopening trade. It's very extreme. So it doesn't mean that we'll turn back into a bullish intermediate posture like tomorrow or Monday, but it means that we probably won't extend the intermediate decline to significantly lower lows here. We might actually have already set the low. Again, so we might be up and down and still be bearish on an intermediate posture basis, but we might have set the low point on the small cap index with today's intraday low, and we might trade in that range Monday, but I expect that we won't go any further other to the downside from there. So do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that would suggest or tell you why you should be either a lot more bullish than I am or a lot more bearish than I am. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and you want us to do another one on Monday. Quick way to give us feedback. Let us know you like our stuff if you do. Of course, if you don't have to click on anything. You don't even have to watch if you don't like it. Also, comment. What did you get out of the video? What stood out to you? What questions or comments you have on what I said? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. And as I said earlier in the video, we do have that Black Friday sale going on right now, so take advantage of that. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these things over here on the right. If you click on the Market Outlook live video, this icon right here, that takes you to this page. You can see all of our My Market Outlook live videos. In these videos, I review all the trades that we've put on in other Market Outlook videos to see whether we should stay in them, get out of them, how do we should manage them, why do we close them, the really important part of the trade, right? Of course, there will be another trade idea at the end of this video, and we've already put that on. We already generally put those on before the market closes. I didn't do one today because of the holiday. I wasn't even planning on, as I said earlier, not planning on doing the Market Outlook today, but considering, I decided to put one on there. But this is where that's at. Again, you can see all the archives down here below. You can also get to it by mousing over Market Outlook and clicking on Live Trade Review. If you come down here on the right, you can see all of our upcoming classes. Click on View More. That takes you to our our trading room page. You can see all of our upcoming classes. We'll have our December classes up here in a few days. All of our 3 years, through almost 3.5, going on 4 years worth of archives. So you can go back and see all those. You can also get to it by clicking on trading rooms up here at the top. Come down here to the bottom, hit that heart. It opens up this new tab. Oops, sorry. This new tab. Hit that like button. Also click on this thumbs up icon. It opens up another new tab. Hit that like button. Again, it really helps us do that because it helps get our content when you do that. And you can do it right now while you're watching. That's why I put it here on this page. But it gets our content out to more of our followers, that people that actually follow these accounts based on how their algorithms work. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it, like I said, easy for you to engage with us right here, right while you're watching. All right, now let's take a look at our price action. This is our kind of the major asset classes are out there, kind of a risk-off day, as you can tell, a very, very risk-off day. As you can see, look at the drop in crude oil. I mean, lots of dark pink shading and red lines all across here. Emerging markets are down. EFA is down. You see the S&P. As a result, VT, which is the global marketplace, is well below its moving average. Copper is broken down. Silver is breaking down. Bitcoin's dark pink shading in a red line. The euro is bouncing up. Remember, the euro is your safe haven trade right now. Kind of like the Qs. The euro, your dollar's been associated with this risk appetite we've been having, and it's the euro's been safe haven. Look at the big jump. Gold kind of held, but look at the big jump in long-term bonds back to dark green shading and a green line. The drop in 10-year yields. So it was definitely a risk-off day, to say the very least, about if you had to describe today here. Let's take a look at what it looked like. Again, it was only a half day of trading too, which is insane that we got this much movement in such a small amount of time. That's why we don't see like a full chart here. You only see kind of a half of a chart because of how we finished. But there's long-term bonds up the most, global bonds up. The gold was up quite a bit until the end of the day, and then it kind of finished off of its highs. And then we hit our lows. Commodities down 6%. Small cap stocks down 4.5%. Emerging markets down 3 1/3. These are your risk asset classes right here, and they're down significantly. And go back to that 3-month that we first had here. You can see now there's emerging markets, there's development. They're pretty negative. Small cap stocks are now almost negative on the 3-month basis. That gives, when you look at the rate of change here, the S&P is still positive on a 3-month. This is 63 days, so 3-month basis. Your Russell 2000 is not. So your Russell 2000 now is negative over the past 3 months. And your Dow Jones Industrial Average is also 1.5% negative over the past 3 months. And then, of course, your NASDAQ 100 still holding a really good 4% gain. But, those numbers are dropping. Emerging markets are down more than 5.5% in the last 3 months. Developed markets down more than almost 4.5%. A little bit of a triple top kind of forming here. So, the rate of change, we're definitely turning negative on the 1-year basis. Even if you were to look at it on a 6-month basis here, 126. So it would be your 6-month, 126 here. We are 4.5% negative on the 6-month. Emerging markets are down 11% 6 months, and then the IWM is down 1% over the last 6 months. Diamonds down less or up less than 1%, and your spider still holding up pretty strong. Qs also holding up really strong. So again, you can kind of see, where the safety is and where the safety is not. Again, I mentioned this margin of safety. I mean, you saw an SPY. I mean, look at all the support below you. You're well above the 1-year point of control. You are in the value area, but look at all that volume below you. Compare that to IWM, where if you were to break this, there's no volume below it. And diamonds is got a similar pattern, right? You've got a bigger chunk of volume here, a bigger range than the 340, but below 340, there's very little volume below. So it's very easy. That's why I say it's, you've got, much poorer margin of safety on these, where you're so high centered. You can see diamonds with this big volume node and the point of control up so high on the 2-year chart is very, very high centered. That's not the case for SPY. It's not very high centered at all. We're well above the 2-year point of control. And Qs, you know, same thing. I mean, look at, you're not so far above it, but you still got, look at all that volume below. So we're not nearly high centered in those areas, and hence when they drop, it'll be more of a slug down to the downside. It'll be harder. Whereas the small caps is free fall. It has, if this support doesn't hold now, there is more of a free fall before it finds its next layer of support. Hence the poorer margin of safety. And remember, that is your safety trade right now. In fact, if you look at this index here, this is interesting. The 10-year yield has dropped below 1.5%. Your 2-year yield, however, which is more reflective of the Federal Reserve's, is more reflective of the Federal Reserve's rate hike odds, is still above 50%. It did drop. We were at 65% previously, so it did drop, but still, I mean, so what that says is now your yield spread is now down below 100 basis points already before the Fed's even raised interest rates once. And the Fed, you know, even with this drop, the market's still pricing in rate hike odds. Here, let's pull up, and not 3 anymore. We were getting over 60% odds for 3 rate hikes, which is high probability by December. So we don't have, you know, those 3, but we're still at 75% chance for rate hikes by next year. Now only 1. Right, basically now only 1, because you've got a 58% chance of staying at 1, so you have about 42% odds for a second. So that's, the rate hike odds have dropped, but not completely. You still have the 1. Someone mentioned, you know, we did talk about, someone mentioned, was there any kind of indicators I saw on Twitter that would suggest this was coming? Remember, we did point this out a couple of days ago, that very, very high, well, I guess it was about a week ago, that very high GEX gamma exposure. That was an extreme number, which means that, you know, market makers have a lot of exposure that can really reverse this up pretty quickly. And we may have saw that to an extreme today, which is good because it might have all happened. They might have covered all their exposure all in one day, which will allow us. You can see dark pool, it isn't too negative, right? We didn't get too low on the dark pool, so there's still demand for dark pool long positions. If we take a look at the new highs and new lows, let's see if it's been updated for today. Going into today, we were pretty negative on Wednesday, below 500. We jump back up. That's going to be down probably a lot more, even below that. So I mean, again, that's suggestive of this idea that we are in decline. You can see the skew has been pretty high, so the market has been anticipating a bigger move. Doesn't suggest, it didn't pinpoint the day, but you can see the market's been very extreme in a lot of its indicators, and you can also see too that, you know, the percent of stocks that have been above, you know, 50 200-day moving averages have been steadily declining, very significantly diverging over the last little bit. Here's your 50-day moving average. After getting back up above, you know, we're just barely above. In fact, I would highly doubt we're even above that mean by the time it's all said and done here when this chart updates. Let's take a quick look at the sector moves. Let's go over here to the sector rotation. Let's look at the 12 grid first. Remember, it's dark pink shading and red lines across the board. Well, look at that. You have an oversold cluster in the communication services already, but you're still dark green shading the green line on discretionary and technology. Real estate and utilities, which are other safety trades, are dark green shading and green line. I mean, we're coming off of a cluster, overbought cluster on real estate. But when you look at financials and industrials, we are a lot further below those moving averages. So they're getting hit the hardest. XLE also getting hit, you know, well below its moving average, dark pink shading and a red line. Materials not as bad. And then you can see these other safety trades. These safety trades, they're all down, but they're just not going to be down as much when you are in a risk off mode. So now let's look at this chart, and again, just look at today alone. And not very much movement today, but You can see energy and financials were your biggest losers, not surprising. Industrials too, but they came off their lows by the end of the day. That's a positive sign. But your safe haven areas: healthcare, staples, utilities, and you can also see materials and communication services, which have been so bearish. Those two have been more bearish than their peers, outperforming the S&P. Still down, but outperforming. There's technology and discretionary kind of matching where real estate was coming off of its overbought cluster, as well as where some of these other areas have been too. All right, well, let's take a look at our trade idea for today. And I wanted to take a look at Applied Materials. Applied Materials is really, had a good breakout move, very similar to the Russell 2000. A good breakout move here. Since peaking there pre-earnings, it's pulled back down to a good bullish pattern here. You still have a strong bullish posture, light pink shading and a yellow line, which is a bullish signal. You have, again, it's not quite an intermediate confirmation signal because we're not above 80, but you do have the intermediate line still above its market sentiment. It's still in the green zone, and we're only less than 1% below the moving average here. When you take a look at its long-term chart for this week, it's what its Hakinyashi candle look like. You can see it's a little bit bearish on the candle. Again, no red arrow though, so that's a relatively good sign in terms of like whether or not we're actually turning bearish on this particular stock or not. You can see we have 1 day of 3 red arrows, right? So again, one of those situations where we either bounce right off of this or we don't, right? One or the other. If you take a look here at the 2-line versions of this chart, Applied Materials, we came down to the top of the value area after having broken through. We're down to the top of the value area, still well above the 50 and 200 day moving average, still above the 1-year point of control. You're dipped a little bit into bearish territory in the stochastics, but not its moving average yet. We're still positive on the MACD despite its declines, and a little bit above average on the volume today. You can see its RSI and the CCI are down, just dipping its toe below 50, below minus 100, a little bit more below on the CCI. When you look at the DMI chart, AMAT, you can see that we are just a smidgen below 20 on the positive and not quite above 25 on the negative. So kind of a little bit of a pullback signal, but not a bearish breakout signal. There's an opportunity that we can bounce right off of this and head our way back up to the upside. That's kind of the idea behind the trade. And if it doesn't bounce, then we want to keep our loss minimal. So if we take a look at the options chain, what we're going to do is sell the 140, buy the 135 put for December. We're still getting a pretty decent credit, probably getting about $1.50 on the trade. We need $1.16 to make the trade worth it. So you can see, remember, we don't have to worry about the earnings announcement, so I can go on the full position size here. I get a pretty decent reward, and if I set my slices to break even and set those slices onto the chart, you can see where that break even is. So we'd have to fall, if you take a look at the 2-line version here of this chart, we'd have to fall down below the point of control for us and below the 50-day moving average for us to take the loss that we'd be willing to take. Here's the Bollinger Bands. Again, same thing. You'd be in the lower half of the see, we're in the lower half of the bandwidth now, but we're not in that lower quartile, and you've got good strong support below where that break even is. So we're okay to come down even a little bit more if we need to, as long as that 50-day holds and this volume support holds and bounces, then we're good to go, and we can get a decent reward for the risk that we're taking on this trade. All right, you've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums on our website, part of our free section of our website. You can open up any new threads there with any questions or comments you have about what I discussed in the video today. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Like us, click that thumbs up icon, like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your holiday weekend, everybody, and we'll see you all on Monday.